They own your butt, and you gave them the deed. Don't give them the deed to your butt.
Welcome, fellow financial mutants. The team has put together some reacts from our friends right down the street.
Brian, I am so excited about this because we love seeing what other financial commentators have to say. Let's dive right in.
My wife and I just got married about a month ago,
George.
and together we have about $165,000 worth of debt. I'm about to be eligible for benefits at my job, and we're trying to figure out if I should go ahead and do the 401k match. If I contribute 6%,
Yes.
then the company contributes 10% on top of that.
And what kind of debt is the 165?
It's mostly student debt. We got about $10,000 of a car loan, and pretty much all the rest of it is student loans. Together, we bring in about $95K before taxes.
Well, the answer to your question is no. You do not enter.
Come on, Dave.
Even though it is ridiculously wonderful and generous, because
Yeah.
it's just a temporary.
It ain't
thing.
coming back.
If you don't focus on this debt exclusively and you try to do three things at once, you're not going to get there. So I hate it because I'm a math nerd and I know what that match will do for you, but it's a temporary thing.
Because what I like about pausing the 401k match is it gets you a little bit angry. You're like, oh my
Dave
gosh,
needs to know
I'm
about the
missing out
wealth
on the match.
multiplier.
Good. Let that fuel you to get rid of your debt faster to get back to the match faster.
I agree to disagree. Agree to disagree. And that's okay. It's okay to disagree, but I do not think that would be the guidance that I would give.
There's a reason in the financial order of operations, step 2 is that employer match. Because if somebody can guarantee you, as the example showed, that was a greater than 100% rate of return.
The interest rate on the debt was not greater
The
than 100%.
student loan, there's no way student loan debt is having anything that's even close to that. I mean, truthfully, the employer match is going to be 10 to 20 times more than what was provided on that. So take advantage of the free money. I mean, that is going to be a huge head start on your financial life.
And this is what I really struggle with. Dave kept saying, it's a temporary problem, it's a temporary problem, it's a temporary problem. We would agree with that. The problem is that when you forego that match, you are now implementing a permanent solution to a temporary problem because you cannot go back in time. You cannot go back and get that match. You cannot go back and let that wealth multiplier start working for you. So don't apply a permanent solution to a temporary problem. I do think it's possible for you to do more than one thing at once and to do that thing well.
Here's a couple of rules we use. Rule number 1 is to be debt-free, which you are. Rule number 2 is when you make your down payment, you need to retain enough to call your emergency fund, which is 3 to 6 months of household expenses. The third thing is never take out more than a 15-year fixed rate, where the payment is more than a fourth of your.
Is this for a primary or rental?
That's the max. You can qualify for almost twice that much, but that doesn't mean you need to be that stupid. Don't do that. Keep it conservative so you can get the house paid off in less than 15 years. That's the goal. Then the last thing is, if you can figure it out, make a down payment of 20% or more with a conventional Fannie Mae loan. You avoid PMI, private mortgage insurance.
Those are wonderful ideals, but in the world in which we live today,
It's a wish list.
That's hard to put, especially for first-time home buyers just now coming out. I got to be debt-free, meaning I've paid off all the other debts that I have, and then I've got to put 20% down, and I have to do a 15-year mortgage. At today's interest rates, what that means is I think that most young Americans, home ownership would be completely off the table for them.
Yeah, I would love to know how old that video is because I think pre-inflation run-up, okay, those are ideals. But I think that now, if you waited to save up 20%, the housing market's running from you.
Run away from
The
you.
other thing that I think is that you're going to find with post-inflation, houses are so much more expensive, you need the 30-year mortgage so you get a little bit more house.
That's right.
When you're in the messy middle where you got kids running around everywhere, you need to be able to get the best version of your of where you can raise your family that fits into your financial life responsibly. Don't make it where you have to squeeze it down so small that the only thing you can actually afford is a tiny house, and then you're miserable because somebody didn't give you all the financial tools or release all the financial tools that might have helped you live your best financial life.
So if you go to moneyguy.com/resources, we actually have a home buying checklist where you can look at our 3 rules. Rule number 1, that when you buy a house, you want to make sure you're in it for at least 5 to 7 years. Rule number 2, if it is your first house, the very first home that you're buying, you don't have to come up with 20% 5% down. It's okay if you do 3.5%. It's okay if you do 5%, so long as you don't breach rule number 3, and that's that your total housing costs cannot exceed 25% of your gross income. I think if you will follow those rules, you're going to have a much higher likelihood of being able to get into a home and being on the other side of home ownership in this market.
What's your net worth now?
Our household net worth between my wife and I is about $1.3 million.
Nice.
Did you launch a course? Did you go zero money down on real estate?
I am a
what did you
W-2
do?
employee. I'm not an entrepreneur guy who leveraged an Airbnb thing while starting a laundromat business. I just used my salary, my greatest wealth building tool, my income.
How did you do it in 11 years? How do you get that net worth?
The first part was realizing that debt was a thief. And so getting out of debt using that debt snowball method was huge because that got me to a baseline where you have a positive net worth when you don't have any debt.
Right.
And you've got a little bit of money in the bank. So I get the emergency fund, I pay off the debt. I began investing into our Roth 401k here at Ramsey, got married to Whitney. Bless her, she's smarter than me and better looking.
Right.
She had no debt. So we start off our marriage with a pile of money in the bank and savings, no debt. And Whitney has had a job here at Ramsey for the last 8 years. I've been here over 10 years. So over that time, we each now have 6 figures in our investments.
We actually do an annual wealth survey of all of our Money Guy clients. And we ask them this question: How did you become a millionaire? How did you reach financial success? And you might be surprised to find out that the vast majority were not entrepreneurs. They were not virtuosos who have some unique skill and talent. They weren't corporate executives that went and climb the executive ladder. They were just like George. They were savers and investors who consistently saved through time. It's not an incredibly complicated formula.
The superpower, live on less than you make. If you can understand that discipline and deferred gratification is the first thing to build margin in your life, let that margin of the money actually start working for you and give it enough time, you too will have the 3 ingredients to wealth and be extremely successful.
Tried the baby steps, had a $2,200 emergency, and ended up $5,000 in the hole. Still doing the baby steps, but I went with a $2,500 emergency fund and have been fine ever since. The $1,000 emergency fund put me in a worse position. Definitely time you update it.
That's funny. Do you want to know kind of a funny moment in my career?
Yeah.
I was writing my first book, Love Your Life, Not Theirs, and I was pushing so hard to change the baby steps.
Wow. To update the $1,000?
Baby step 1. Yes. I really was pushing to do it a month
of expenses.
1 month of expenses being baby step 1. And of course, me and Dave, as you can imagine, went back. And he kept saying, which now I'm like, oh, I get it. He kept saying $1,000 was never enough.
Never enough. I've heard Dave say this thing too. $1,000 was never supposed to be the stopping point. It was always supposed to be the starting point to get you moving on the path. But I think a lot of people find themselves in that same position. Hey, I had this emergency fund, and then an emergency happened, and I'm right back to where I started. So there is some tension there. There's a little bit of rub there.
We don't want you making desperate decisions where you have to go to debt or other horrible solutions to this emergency that you're facing. So that's why we actually, on our step 1 of the financial order of operations, we did highest deductible.
Yep.
That way you could actually figure out, don't just go out what feels good or some random number. If Dave is willing to admit 1,000 is not enough, then what should you do? How about we actually put to paper what are your biggest risks, and we actually just cover that deductible so you can actually live your best life and not get thrown into a financial ditch.
Or if I start pitching you a savings account on TikTok and I said, hey, here's your savings account. The first 3 years you put money in, nothing happens. We keep it all. After that, it makes 1.2%. And
He's talking about life insurance.
You lose your money.
Guarantee it.
No one would put money in that. That's a whole life policy. So nobody ought to put money in a whole life policy.
I love it. I love what Dave said. Now, I think I'll have a little bit. He said no one should put. I don't want to be so aggressive to say that it never, ever, 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 under any circumstance makes sense. But the amount of circumstances it makes sense in is so minuscule because of exactly what he just said. I loved it.
Let me tell you, no one within the whole life industry is going to put Dave Ramsey in charge of their brochure because that is, I mean, that's quite something.
That's exactly right. We love term life insurance. If you need to insure against your premature death, the best way to do that at the lowest cost possible is term life insurance. You're going to put the biggest bang for the buck and make sure that you and your loved ones are protected. That's what insurance is there for. Let insurance be insurance, and let wealth building tools like investment accounts be wealth building and tools like investment accounts.
The average car payment in America today is approaching $700.
It's over now.
10 months of that is $7,000, which will buy a fine vehicle to drive for a few months until you could save up another $7,000 10 months later and buy a $14,000 vehicle. Y'all with me here? You can stay away from car payments by paying cash for reliable used cars.
I don't disagree. I do think that it's hard to get reliable transportation for $7,000. I grew up in a household where my father was a mechanic, my brother was a mechanic. They are the type of people that could drive
anything. They can make anything work.
Right? That type of beater car that you can get for cheap. For me, I needed to get to my job. That was going to be the first wealth builder that I was going to have. So I needed reliable transportation. That's why we do 23-8, where you 20% down, don't finance longer than 3 years, and it cannot exceed 8% of your income. Because this is important that you're thinking Corolla, not Land Cruiser. Yep. We're trying to get you to your job so you can get wealth from saving and investing. And I'm not going to put you in something that you're scared to put your family in for safety or reliability.
Not even that. I'm nervous about this idea of sending good money after bad money. Because just because you go buy a $7,000 car doesn't mean that it's necessarily going to be reliable. It might mean that 1 month down the road, then you have a $1,000 repair, and then this happens, and this happens. I would much rather you be in a reasonable car using 23-8 so that you're not just turning this automobile into a money pit that keeps sucking your resources.
Now, I will tell you, Dave is right, though. Too many people are driving around in their potential wealth. If you're spending $700 to $1,000 a month on your monthly car payment, what could that become if you just let that be an investment instead? So I don't completely agree with everything Dave said there, but you do need to make sure you don't drive around in a car that you can't afford that's actually stealing your future wealth.
I'm going to put it on a credit card and act like nothing changed. These companies are screwing you, and you're signing up for the trip, and you're getting hammered at 18 to 28%, and you wonder why you make $100,000 a year and have no money. It's out of control, you guys. They have lulled you to sleep. They've made you believe you have to have one of these stupid things to exist. Don't leave home without it. You can make it without these stupid things. Get you a debit card, pay cash for it, get control of your life, get some autonomy from these banks. They own your butt, and you gave them the deed. Don't give them the deed to your butt. They own you.
I don't disagree with Dave. It's just that I'm willing to say I can flip the script.
Yeah.
And the fact that I own the banks, and the fact that when I use a credit card, I never, ever carry a balance. Because credit card use is okay, but credit card debt, no way. That's the thing that I think, if you know that you're disciplined. Dave goes the teetotal way because he just assumes everyone falls into the trap he fell into, where you're going to just not be able to save yourself from your lack of discipline or ability to pay off the debt. If you know yourself, if you know that you can actually, watch out microphone, if you know you can actually pay off the debt every month, it's okay to use that as a tool. That's where I'm a little different. But he is right that a lot of people are faking their life and getting into debt and being the servant of all the debt that they owe and have to pay off.
Yeah, I completely agree. If you have $100,000 income and you're still paycheck to paycheck because of all this debt you're servicing, you may not be a credit card person. And if you can't exercise that discipline, then maybe you should get rid of them. You should not use credit cards. You should only use debit cards and only pay cash. But if that does not describe you, I think that there's a balance where you can be a responsible credit card user, but only for the right type of person. Some people do need to teetotal and stay away from it. So if what he described is you, be true to yourself and make the right decision.
If you do these 5 things, you will win with money 100% of the time.
That sounds like a guarantee.
You need to have a written plan, a budget. Okay. No one accidentally wins. Okay. Second thing is you got to get out of debt. Your most powerful wealth building tool is your income. And when you spend your whole freaking life giving your money to banks who fill up the skyline and have furniture nicer than yours, that makes you stupid. Number 3. Live on less than you make.
I like that. Okay.
My life is not good enough the way it is, and so I am going to control the controllables. I am going to change some things. And then you're going to save some money. You know how rich people get
this sounds like the 3 ingredients to wealth.
I love it.
If you'll get
margin.
Out of debt and you'll invest and you live on less than you make and you have a plan, then you can do the last one. It's the most fun you'll ever have with money. You can be outrageously generous.
All right. Okay.
I love it. I don't hate it. I don't hate those things.
Yeah, I mean, Dave, there's a reason that we say that Dave and them are friends, and the fact they're down the street from us. They have helped more people get out of debt. Because I mean, and look, the majority of Americans do struggle with basic discipline. They can't live on less than they make, and they run up all this debt to the banks. He's exactly right on that. I think where we kind of deviate a little bit is that once you get beyond the basics, meaning that you don't struggle paying off the debt, now you're getting into a point where you want to be a financial mutant. You want to optimize. That's where I think our system, the financial order of operations, kind of helps you add to what Dave is talking about, which we want to take you beyond the common sense of just paying off your debt every month.
I love the things he said. If you can just be disciplined, live on less than you make, have a budget, have a plan, put that plan in place, save and invest for the future, and then be generous with your wealth as well as your time and your resources, that is a recipe for a successful financial life. I love it.
I think this was good. I loved kind of showing, comparing, contrasting. As you can see, the good information's out there, but I think there's always a better way to do money, and we're going to be your source. Check out moneyguy.com. Money Guy team, out.